Welcome back to the Daily Crypto Roundup. Today's episode is about context, not hype, not panic, and not chasing every headline, but understanding where the market actually is right now, why price action looks the way it does, and what stories matter heading into next week. We've got a bit of consolidation across the majors, some genuinely interesting global adoption stories, a couple of industry controversies worth paying attention to, and some calendar events coming up that could drive volatility whether people are ready for it or not. We'll go through the prices first, so everyone's grounded. Then we'll dig into the stories, the analyst takes around them, and finally what's coming up over the next few days that could move the market. And as always, before we get into it, just a quick note on the community. It's been good to see the comments continuing to pick up, new names joining in, familiar ones sticking around, and people actually engaging with the ideas, rather than just shouting price targets. That's exactly what we're trying to build here. And while we're at it, let's reveal the winners of this week's giveaway. Shout out to today's winners. Moonhead483 is getting 10 XRP, and Bensitsa17 is getting 5 XRP. Please drop your wallet addresses below, include the memo if one is required, and let us know if it's cold storage so we can send it straight away without any delays. Alright. Let's start with where the market actually sits today. Bitcoin is currently trading around $94,500, having cooled slightly after pushing toward the high 90,000s earlier in the week. Ethereum is sitting just above $3,200, also easing back a little but holding above key levels. XRP is trading around $2, Solana around $140, Binance Coin is $930, Cardano around 39-cent range, Dogecoin around 13 to 14 cents, and the rest of the top 10 broadly reflecting the same theme, consolidation rather than collapse. The important point here is not that price has pulled back a bit. The important point is how it's pulled back. There's no sign of panic, no cascade of forced selling, no sudden spike in fear metrics. This looks like the market catching its breath after a strong move, not the market rolling over. Bitcoin dominance has ticked up slightly again, suggesting capital is temporarily favoring the larger assets while traders reassess risk. Sentiment indicators back that up. We're not in extreme greed, and we're not in fear either. We're in that uncomfortable middle ground where people aren't sure whether to chase or wait. And historically, that's often where markets build their next move. One interesting data point that's been noted by on-chain analysts today is that despite Bitcoin rising over the last week, social sentiment has actually turned more bearish. In simple terms, price has gone up while online commentary has become more skeptical. That divergence is worth paying attention to, because markets tend to move against the crowd. When everyone's bullish, upside dries up. When people doubt rallies, they often have more room to run. Now let's get into the stories. One of the more subtle but important narratives today is institutional reassessment, not in the sense of people rushing in or out, but in how institutions are thinking about long-term risk. A notable example came from a senior strategist at Jefferies, who removed Bitcoin from a flagship portfolio, not because of regulation, price volatility, or macro conditions, but because of concerns around quantum computing and long-term cryptographic security. Now, this is important to frame properly. This is not a call saying Bitcoin is about to be broken. This is not a panic signal. What it is a reminder that institutional investors don't just think in quarters or years. They think in decades. And once quantum risk moves from academic discussion into portfolio consideration, that tells you something about how mature the asset class has become. Bitcoin is now big enough, relevant enough, and permanent enough that people are thinking about its far future resilience. Interestingly, around the same time, a very old Bitcoin wallet, inactive since 2010, suddenly moved a large amount of Bitcoin. That immediately sparked speculation online. Some people jumped to conclusions about selling, others about security concerns, others about early miners repositioning. The reality is, we don't know why those coins moved. What we do know is that the market absorbed it without drama. That matters more than the story itself. A decade ago, a move like that would have rattled confidence. Today, it barely registers beyond a headline. That's a sign of liquidity and maturity. Now let's pivot away from price and speculation and talk about real-world usage, because this is where today's roundup gets genuinely interesting. A new analysis has shown that crypto usage in Iran surged to nearly $8 billion in transaction volume last year. That's not driven by traders chasing gains, it's driven by economic reality. High inflation, currency collapse, sanctions, and limited access to global finance have pushed ordinary people toward crypto as a store of value and a means of transfer. What's important here is nuance. Crypto in Iran is being used both by everyday citizens trying to preserve savings and by sanctioned entities trying to move funds around restrictions. Both things can be true at the same time. This is exactly why crypto remains controversial and powerful. It doesn't discriminate between good and bad actors. It's a tool. And like any tool, it reflects the incentives of the environment it's used in. For listeners, the takeaway here isn't politics. It's understanding that crypto adoption doesn't always look like Silicon Valley optimism. Sometimes it looks like survival. And once crypto becomes embedded in daily life for that reason, it's incredibly difficult to unwind. Now let's move to a completely different, but equally important story. What Ethereum's founder is actually using. Vitalik Buterin recently highlighted 3 applications he says genuinely reflect Ethereum's original ideals and are now usable in the real world. These weren't speculative DeFi protocols or meme projects. They were tools focused on privacy, communication, and collaboration. Things like decentralized document sharing, messaging, and self-custody wallets. Now the question you will be asking is, why does this matter? Because it cuts through the noise. Ethereum gets criticized constantly for complexity, fees, and scaling debates. But underneath all of that, real products are being built, refined, and quietly adopted. When the person who created the platform points to specific apps and says, "This is what it was meant for," that's worth listening to. It also helps break the narrative that crypto is only about trading. For long-term confidence, the ecosystem needs more than charts. It needs tools people actually use. And according to Vitalik, that's starting to happen in ways that aren't flashy, but are meaningful. Now let's talk about risk, because not all stories today are positive. An investigation published into a project called BlockDAG has raised serious questions about fundraising claims, delivery of mining equipment, and internal financial practices. The reporting suggests discrepancies between what was publicly claimed and what may have actually occurred, including issues around undelivered products, unpaid obligations, and overstated milestones. This is an important story to include because it's a reminder that not everything in crypto is innovation. Some things are just poorly run, or worse. And in markets where confidence is returning, these kinds of stories tend to reappear because capital flows faster than due diligence. The takeaway here is the value here isn't fear, it's awareness. When markets heat up, scrutiny matters more, not less. And as one industry figure put it, fundraising in crypto needs more transparent, auditable structures if it wants to be taken seriously long-term. Now let's shift to corporate and industry developments, because there were a few today that flew under the radar. Polygon Labs announced a significant restructuring, cutting close to 30% of staff while doubling down on payments and stablecoin infrastructure. This comes after acquisitions aimed at building out real-world payment rails rather than speculative tooling. This isn't a failure story, it's a maturation story. Crypto companies are learning, sometimes painfully, that focus matters. The days of doing everything at once are fading. What's emerging instead is a clearer separation between infrastructure, speculation, and utility. At the same time, crypto sponsorship is making another mainstream push. A major crypto firm has become a headline sponsor for a Formula One team in partnership with a large fintech brand. Whether people love or hate crypto marketing in sports, the fact is that companies only spend that kind of money when they believe the cycle is turning. Marketing spend tends to lag bear markets and lead recoveries. Now let's talk about corporate Bitcoin and Ethereum accumulation, because this theme continues quietly in the background. A publicly listed company added another 200 Bitcoin to its balance sheet this week, reaffirming its long-term commitment to holding digital assets as reserves. At the same time, an Ethereum-focused treasury company held a shareholder meeting to massively expand its authorized share count, with the explicit goal of raising more capital to buy more Ethereum. What made that meeting notable wasn't just the vote passing, it was who attended. Seeing major figures from both crypto and AI worlds present at a meeting about digital asset treasuries tells you something about where serious capital believes this is going. This isn't retail mania. This is balance sheet strategy. Now let's get into on-chain signals, because this is where things get nuanced. Bitcoin exchange balances continue to trend lower, meaning more coins are being moved into private custody rather than sitting on exchanges ready to sell. That doesn't guarantee higher prices, but it does reduce immediate selling pressure. Historically, prolonged periods of exchange outflows have aligned with longer-term bullish structures. XRP, on the other hand, is showing an interesting divergence. Transaction counts remain high, but the value being transferred is relatively low. In other words, lots of small movements, fewer large ones. Analysts suggest this may indicate institutional exposure is increasingly happening off-chain via custodial products rather than on the ledger itself. That matters because it shows how market structure is changing. Not all adoption shows up in the same metrics it used to. Ethereum staking is another quiet story. The staking queue has cleared, and large amounts of Ethereum continue to be locked up. Over time, that reduces circulating supply and adds a yield component to holding it, which subtly changes its investment profile. Now let's look ahead, because this is where the next week comes into focus. The biggest near-term calendar event is a major token unlock scheduled in the coming days. A very large portion of supply for a DeFi-focused project is set to be released. Historically, events like this can create volatility, sometimes sharp sell-offs, sometimes surprisingly muted reactions if much of the selling has already happened or tokens are distributed strategically. This isn't about predicting price, it's about knowing when volatility is possible. And next week, it is. There are also no major protocol upgrades scheduled for Bitcoin or Ethereum in the immediate term, which means market movement is more likely to be driven by liquidity, sentiment, and macro commentary, rather than technical changes. Several crypto conferences are taking place alongside broader global economic forums, which often produce headlines, commentary, and narrative shifts, even if they don't immediately move price. And finally, macro events continue in the background. Central bank speeches, tech earnings, and geopolitical developments all feed into risk appetite. Crypto doesn't trade in isolation anymore. It's part of the broader financial ecosystem, whether people like that or not. So where does that leave us? It leaves us in a market that is strong but cautious, confident but not euphoric, and increasingly shaped by institutional behavior rather than retail frenzy. The stories today weren't about sudden pumps or crashes. They were about structure, adoption, scrutiny, and preparation. That's usually how important phases begin. If you're listening to this thinking you've missed something, you probably haven't. Markets don't reward urgency. They reward understanding. As always, drop your thoughts in the comments, make sure you're in for the XRP giveaway, and let us know what you're watching next week. Thanks for listening. And as always, we will see you at the top.